Welcome to a new deep dive. We've got a stack of information you shared with us, articles, reports, analyses, all focused on a single day, June 11th, 2025.
Yeah, think of it like taking a snapshot of the global financial landscape right at that moment. Our goal really is to sift through it, pull out the most important nuggets, find those, surprising facts, and figure out the so what behind the headlines.
Right, so you get a clear, concise understanding of what was driving the world economy on that specific day.
Exactly. And as we dug through these sources, a really strong theme emerged, didn't it?
It really did. It's the continued powerful influence of trade tensions on global growth and inflation. I mean, even amidst whispers of potential deals, that uncertainty is just a major force.
Yes, absolutely. That thread is woven right through the material. It's kind of the backdrop against which everything else is happening.
Okay, let's unpack this then, starting with that big picture outlook. The sources highlight a pretty stark warning delivered by the World Bank just the day before June 10th.
Stark is the right word. They significantly downgraded their global growth forecast for 2025. We're talking a cut down to just 2.3%.
2.3%.
Wow. And that's a substantial 0.4 percentage point reduction from their earlier predictions. It puts global growth at the slowest pace since 2008, if you exclude the actual recession years.
And what really stands out here, what the sources tell us, is the World Bank directly linked this slowdown to heightened trade tensions and policy uncertainty. They were quite specific, weren't they?
Oh, absolutely. Explicitly mentioning President Donald Trump's erratic trade policies and high tariffs as key drivers, that level of direct attribution is notable.
And the impact on global trade growth itself. Even worse, it seems.
Yeah, projected to plummet even more dramatically, down to just 1.8% in 2025. I mean, think about that compared to 3.4% in 2024, or the 5.9% average growth we saw back in the 2000s. It's a huge deceleration.
And this isn't just hitting a few spots, is it? It's broad-based.
Very broad. According to the sources, about 70% of economies globally, we're talking the US, China, Europe, they all saw their growth forecasts trimmed. Advanced economies are now looking at, well, a sluggish 1.2% growth overall.
Just 1.2. And what about specific areas?
Well, that breaks down to just 0.7% for the euro area and Japan individually. And emerging markets, they're slowing down too, projected at 3.8%.
And inflation, still sticky.
Expected to persist above pre-COVID levels, yeah. Forecasts at 2.9% for 2025. The sources cite factors like, well, the tariffs we mentioned, and also tight labor markets contributing to that.
The World Bank's chief economist. There was a quote, wasn't there, something about turbulence?
Yes, quoted as saying the global economy has entered turbulence and basically missed its chance for a soft landing precisely because of these trade issues.
It really makes you think about the potential upside if things were different. One source mentioned having tariffs could add, what, 0.2 percentage points?
Yeah, potentially 0.2 percentage points to global growth in both 2025 and 2026. That's, not insignificant just from reducing that friction.
It powerfully illustrates how these policy choices, they aren't just abstract political games. They have real, tangible costs globally.
Exactly. But, okay, against this kind of gloomy backdrop, the sources do mention a significant potential step in U.S.-China trade talks around that time.
Yeah, right. After those talks in London.
Yes. Following 2 days of high-level discussions, a framework to implement a trade deal was reportedly reached right on June 11th.
Okay, a framework. What did that actually involve, according to the reports?
Well, it's subject to approval by Presidents Trump and Xi, obviously. But the core idea seems to be China approving crucial rare earth mineral exports, vital for manufacturing in exchange for the U.S. easing some restrictions on advanced tech sales to China.
Any specific examples?
Jet engine sales were specifically mentioned as one area where restrictions might loosen. It seems aimed at addressing that blow up over rare earths that really messed up supply chains.
And China agreed to something specific on rare earths.
Yeah. Reportedly, yes. A 6-month limit on rare earth export licenses specifically for U.S. automakers and manufacturers. Kind of a focused concession.
So, okay, a framework.
Mm-hmm.
That sounds like progress, maybe. Does it mean tensions were actually easing?
Well, it's a potential step, certainly. But the sources are really clear that despite this framework, the underlying uncertainty around trade policies continued to, cast a long shadow over businesses.
How did that show up?
Well, look at designer brands, for instance. They explicitly withdrew their 2025 financial forecasts, citing this uncertainty. Their stock tanked like over 20% on Juneteenth.
Wow.
And on the data side, China's exports to the U.S., they plunged. A sharp 34.5% drop in May. That's the steepest decline since the pandemic hit.
A 34.5% drop. That's huge. What does that number tell you about the real-world impact?
It tells us that, despite the talks and potential frameworks, the tariffs and the general friction were having a massive negative impact on the actual flow of goods. Companies were clearly still holding back.
So the takeaway
You
is,
know,
even with this framework, the big problems weren't solved.
Pretty much. The sources suggest the fundamental issues, what one source even called the political chicken game, were ongoing. And that makes long-term planning, securing supply chains, making big investment decisions, just incredibly difficult for businesses everywhere.
Okay, so we've seen that heavy hand of trade uncertainty on the global numbers and business sentiment.
hmm
How were central banks responding? Let's shift gears a bit and look at monetary policy.
Right, and this is where it gets really fascinating because you see central banks acting very differently based on their own local situations.
Starting with Europe, the ECB.
Yeah, in the euro area, the European Central Bank Governing Council made a notable decision. They lowered their three key interest rates by 25 basis points, effective right on June 11th.
And the why behind that cut is important, isn't it?
Absolutely. The sources state it's because inflation was seen as being close to their 2% medium-term target. Their projections were revised down, mostly because of lower energy prices and a stronger euro.
So they felt they had room to ease a bit.
Seems like it. They're projecting euro area GDP growth at a pretty modest 100.9% for 2025, and they emphasized, a data-driven approach going forward. They seem to be hoping government investment and household spending might pick up some of the slack from trade uncertainty hitting exports and business investment.
Okay, now contrast that with India. What was the RBI doing?
A very different story. The Reserve Bank of India delivered a larger than expected 50 basis point cut to its key repo rate, bringing it down to 5.50%.
50 basis points. That's quite a move. And they did something else too, right, with reserves?
Yes, an even more aggressive step. The RBI also reduced the cash reserve ratio, the CRR, by a full 100 basis points.
Wow, okay. Why so aggressive?
Well, it points to a totally different priority. The RBI is cutting rates more forcefully precisely because inflation there had remained below their 4% target. Retail inflation was only 3.2% in April.
So they're using policy to actively boost growth because inflation isn't the main worry.
Exactly, they have the headroom. And that CRR cut alone, it's expected to free up something like $30 billion, or 2.5 lakh crore rupees, in lendable cash for the banking system.
So for someone in India, what does that mean in practical terms? More lending.
Potentially, yes. Banks have more money to lend out. So borrowers might see lower loan payments, EMIs, as they're known there, making borrowing cheaper. The flip side, of course, is savers might see lower returns on their deposits.
And did the RBI change its growth forecast?
No, they maintained their GDP growth forecast at 6.5% for the 2025-26 fiscal year, still expecting India to be the world's fastest growing major economy.
So what's really insightful here is seeing these completely different paths. ECB easing cautiously because inflation is near target. RBI easing aggressively because inflation is below target and they want to kickstart growth. All against that same backdrop of global trade worries.
Precisely. It highlights how local conditions, especially inflation dynamics, are driving policy divergence. And these divergent paths, they raise big questions, right? How might these different interest rate environments affect global capital flows, currency movements? Money tends to chase yield, after all.
Definitely something to watch.
Yeah.
Okay, let's bring it back home to the U.S. economy. The picture there on June 11th looked pretty mixed based on the sources.
Yeah, definitely mixed signals. On the inflation front, the Consumer Price Index, the CPI data for May 2025, actually looked pretty good.
Good how?
It showed just a modest 0.1% increase month over month. That brought the annual rise down to 2.4%. And core CPI, stripping out food and energy, that was also contained up just 0.1% monthly and 2.8% annually. Energy prices, especially gas, even fell month on month.
Okay, so inflation looking tame. How was that received?
Well, the White House, citing this data, claimed America was defeating inflation. They highlighted it was the second month running with lighter than expected numbers, and they pointed to strong wage growth, too.
Wages were up.
Yeah, the sources note real wages for production and non-supervisory workers saw their highest monthly jump in nearly a year in May, up around 2% over the past year. So this better-than-expected inflation data, it definitely fueled market hopes for maybe 2 Fed rate cuts by the end of the year.
But you said mixed signals. So what was the less rosy news?
Labor productivity. U.S. non-farm business labor productivity actually decreased by 1.5% in the first quarter of 2025. That was the first decline since the second quarter 2022.
And why did it decrease? Output down or hours up?
Both, actually. Output fell slightly, 0.2%, while hours worked increased by 1.3%.
Okay, so more people working more hours but producing slightly less overall. That doesn't sound good.
No, it's not ideal because when productivity falls while hours worked go up, it means you're paying people more for basically the same or even less output. And that pushes up unit labor costs.
The cost per item produced.
Exactly. And those unit labor costs rose significantly, jumping by 6.6% in Q1. That's a big leap and potentially a warning sign for either company profits or, future inflation if businesses pass those costs on.
Okay, tricky situation. Now, on the policy front, the sources also mentioned the House passing a mega tax bill.
Yes, and within that bill, there's a provision that got a lot of attention.
Good.
A controversial unfair foreign taxes provision, Section 899, I think it was called.
Unfair foreign taxes.
Yeah.
What does that mean?
Well, it gets complicated, but essentially this provision could let the federal government slap a potentially 30% tax rate on foreign companies if their home countries are deemed to charge unfair foreign taxes on U.S. companies.
Right. And what's the potential impact of that on the U.S. economy?
Well, there's an analysis cited in the sources from the Global Business Alliance estimating this specific provision alone could cost the U.S., get this, 360,000 jobs and $55 billion a year in lost GDP over 10 years.
Wow. So it highlights a contradiction.
Exactly. The sources point out this tension between trying to attract foreign investment, which we know creates jobs, while simultaneously setting up a mechanism to potentially hit those same foreign companies with a massive tax based on their home country's policies. It's presented as a sort of strategic conflict.
And the overall tax bill itself, what about its fiscal impact?
Big numbers there, too. Projected to add a substantial $2.4 trillion to the deficit over a decade.
$2.4 trillion.
Yeah.
Even though it aims to boost GDP.
Yeah. Despite aiming for a modest long-run GDP boost of about 0.8%, the bill includes tax cuts like making the TCJA changes permanent, temporarily boosting the standard deduction, allowing full R&D expensing, but also the sources mention concerns about potential cuts to programs like Medicaid and food assistance, and even a call to end the low-income housing tax credit, the LIHTC program.
So putting it all together for the U.S., it's a complex mix. Good news on inflation and wages, maybe, but worrying signs on productivity and labor costs. And then this major tax bill with big growth aims, but also big deficit implications and controversial elements.
Absolutely. Policymakers are wrestling with some really tough trade-off there, trying to stimulate growth but potentially risking foreign investment and adding significantly to the debt. Lots of potential unintended consequences that everyone would have been watching very closely.
Okay, so finally, let's zoom in on the markets and specific companies. How did all these macro trends, the global uncertainty, the central bank moves, the U.S. mixed signals actually play out around June 11th?
Well, U.S. stock markets had a bit of a mixed performance right around then. On Juneteenth, things were looking up. The S&P 500 gained 0.5%, Dow up 0.2%, NASDAQ 0.6%. The sources suggest this was mostly optimism, hopes that those U.S.-China talks might actually lead to some tariff reductions.
But that optimism didn't last.
Seems not. The rally stalled on June 11th. The S&P 500 dipped 0.3%, its first loss in 4 days, actually. And the NASDAQ slipped 0.5%, pulled down noticeably by some big tech names like Apple, which was down nearly 2%. The Dow was pretty much flat.
Okay, so market's a bit hesitant. What about individual companies? Any standouts?
Yeah, some definitely performed strongly despite the uncertainty. Oracle, for example, announced really robust fiscal Q4 results. Total revenue up 11% year over year, and crucially, their cloud revenue jumped a significant 27%. That's a big number.
Cloud's still booming then. Any other highlights? Innovation.
Definitely. VS Data and Ramp were named to the CNBC Disruptor 50 list for 2025. VS Data showed huge year-over-year growth, apparently, and Ramp highlighted some really impressive savings numbers for its customers, something like $2 million and 20 million hours saved.
Impressive. Were companies making big strategic moves too?
Yes, adapting to the environment. Dana Incorporated, for instance, announced a big sale of its off-highway business for $2.7 billion. The plan was to use that cash to pay down debt and return capital to shareholders. Bank of America also planned to redeem about $3 billion in senior notes.
And there was that. Interesting trend mentioned in the sources, something about Bitcoin.
Yes. The continued rise of what's being called corporate Bitcoin treasury strategies. Strategy, formerly MicroStrategy, they bought another chunk of Bitcoin, $110.2 million worth. That brought their total holdings to a massive 582,000 BTC.
582,000 Bitcoin. Wow. Were others doing it too?
Yeah, Color Art Technology Group announced plans for a large capital raise specifically to fund its own Bitcoin acquisition strategy. And even Trump's media company reportedly had plans to buy Bitcoin.
So what's the thinking behind that? Why are companies doing this?
Well, proponents see it as providing kind of structural support for Bitcoin's long-term value, positioning it almost as a form of digital gold, maybe a hedge against the very traditional market volatility and inflation worries we've been talking about. It reflects this search for alternative asset strategies in, uncertain times.
Fascinating. But of course, not all companies were thriving, right?
No, definitely not. Core and Main saw its shares fall after missing profit estimates. They gave a pretty flat market outlook too, and explicitly pointed to tariffs and interest rates as headwinds.
In designer brands we mentioned earlier.
Right, pulling their forecasts due to trade uncertainty. And J.M. Smucker, their stock fell even though they beat earnings expectations just because their future guidance disappointed investors. Shows how forward-looking the market is.
What about commodities and currencies on the day?
Commodities saw some interesting moves on June 11th. Crude oil and gold both rose notably. Platinum and palladium were up too, while copper actually declined. And exchange rates, while various movements against the US dollar, the Indian rupee around 85.45, Japanese yen near 144.88, Chinese yuan about 7.186.
Okay, so wrapping up the market picture, a bit mixed overall.
But
Clear signs of companies adapting.
yeah, I think that's fair. Broad market reaction was hesitant, maybe a bit nervous, but specific corporate performances and strategies really show companies actively navigating these macroeconomic crosscurrents. Some sectors like tech and AI seemed quite resilient. Others clearly struggled with the trade and interest rate environment. And then you had this, well, surprising perhaps, trend emerging with companies adopting Bitcoin as an alternative treasury asset.
So putting it all together from our deep dive today, on June 11th, 2025, the global economy was really grappling with downgraded growth forecasts, directly tied, it seems, to trade tensions. Central banks were making quite distinct policy choices based on their local conditions, inflation being the key differentiator there.
And the U.S. economy was presenting that really complicated mix, positive inflation and wage data, yes, but alongside concerning productivity trends and these big policy trade-offs in the tax bill.
Right, and corporations were navigating these waters in very different ways. Strong tech performance, strategic sales, and that interesting emergence of the Bitcoin treasury trend.
It all paints a picture of a world still very much dominated by policy uncertainty, especially around trade. And it shows how localized conditions can really drive global financial dynamics in sometimes surprising ways.
Definitely. So here's a final thought for you, our listeners, to consider based on all this. Given the World Bank's pretty clear assessment that trade tensions were the primary driver of the global slowdown, the reason we missed that soft landing, how might this persistent uncertainty around trade policies, even if specific limited deals are struck, how might that fundamentally reshape global supply chains and international investment flows in the long term? Something to mull over.